if your spouse passed away and you're a surviving spouse of a retirement account, there's really 5 options for a surviving spouse. Number 1 is you could treat the IRA as if it was your own IRA. You can roll over the inherited IRA into your own IRA, and this allows you to treat the assets as if they were always yours, which could be beneficial if you want to delay required minimum distributions until you reach age 73. The second option is you could keep the IRA as an inherited IRA. This option requires you to start taking RMDs based on your life expectancy or within a 10-year period, depending on the circumstances. As I mentioned earlier, it really goes back to how old your spouse was when they passed away and if they had reached their required beginning date or not. The third option is you can elect to be treated as a deceased spouse. This means that the required minimum distributions for the surviving spouse would be delayed until the deceased spouse would have reached the age at which RMDs begin. Now, what's interesting is under the final regulations in July of 2024, the IRS stated that there's no time limit for this election. So you might be able to hold an inherited IRA, which allows you to start taking RMDs based on your life expectancy or have that 10-year time period. And then maybe 4, 5, 6 years later, you can switch it and actually be elected to be treated as the deceased spouse. But there's some complex rules you need to navigate known as hypothetical RMD rules that are now in force based on the Secure Act. The fourth option is you could just withdraw the assets, which would cause you to pay tax on that entire withdrawal immediately. But if it's a small IRA account, maybe you're in a lower income tax bracket, that might be the easiest thing for you. And then last but not least, you could potentially disclaim the inheritance. If you don't need the assets or you want them to pass on to another beneficiary, you could disclaim the inheritance. It means you refuse the assets, allowing them to pass on to the contingent beneficiary. And this could be a unique estate planning strategy specifically for a surviving spouse that has a high net worth and could potentially be subject to estate taxes, which are scheduled to get cut in half from an exemption standpoint at the end of next year. So again, a lot of complication around IRAs. These are very complicated.